Welcome to Muscular Brain, Fat Wallet. In today's video, we'll be diving into an essential topic for anyone considering home financing: MRTA versus MLTA. These acronyms stand for Mortgage Reducing Term Assurance and Mortgage Level Term Assurance, respectively. Understanding the differences between these two types of mortgage protection insurance can help you make informed decisions about safeguarding your investment and ensuring financial security for your loved ones. So, if you're ready to explore the world of mortgage protection and discover which option is right for you, stick around as we unpack everything you need to know about MRTA and MLTA. Chapter 1. What is MRTA? Mortgage Reducing Term Assurance, MRTA, is a type of life insurance specifically designed to cover the outstanding balance on your mortgage in the event of your untimely death. Here are some key features of MRTA. 1. Reducing coverage. As you pay off your mortgage, the coverage amount also decreases. This means that if you pass away, the insurance payout will go directly toward paying off the remaining mortgage balance, ensuring your family retains ownership of the home without the financial burden of the mortgage. 2. Affordability. MRTA premiums, often lower than other life insurance products because the coverage decreases over time. This makes it an affordable option for many homeowners, especially those on a tight budget. 3. Joint policies. MRTA can be purchased as a joint policy, covering two borrowers under a single plan. In the event of either party's death, the outstanding mortgage balance will be paid off, providing peace of mind for both parties. 4. Limited to mortgage coverage. One downside of MRTA is that it's specifically designed to cover the mortgage. If you want additional life coverage for other financial responsibilities, you'll need to consider separate life insurance policies. Chapter 2. What is MLTA? Mortgage Level Term Assurance, MLTA, is another form of mortgage protection insurance, but it operates differently from MRTA. Here's what you need to know about MLTA. 1. Level coverage. Unlike MRTA, MLTA provides a fixed coverage amount that remains constant throughout the policy's duration. This means that if you pass away at any time during the term, your beneficiaries will receive the full payout, regardless of how much you still owe on your mortgage. 2. Additional financial security. With MLTA, your family will not only have the mortgage paid off but will also receive a lump sum that can be used for other expenses, such as daily living costs, education, or even debts outside of the mortgage. 3. Higher premiums. Due to the nature of level coverage, MLTA premiums tend to be higher than MRTA premiums. Homeowners should weigh the additional costs against the potential benefits of having extra coverage. 4. Flexibility. In use. The payout from MLTA can be used at the policyholder's discretion, giving beneficiaries greater flexibility in managing finances after the loss of a loved one. Chapter 3. Key differences between MRTA and MLTA. Now that we've defined MRTA and MLTA, let's summarize the key differences between these two mortgage protection options. 1. Coverage structure. 1. MRTA. Coverage reduces over time as the mortgage balance decreases. 2. MLTA. Coverage remains constant throughout the policy term. 2. Premium costs. 1. MRTA. Typically lower premiums, making it more affordable. 2. MLTA. Generally higher premiums due to level coverage. 3. Payout use. 1. MRTA. Payout goes directly to the mortgage lender to pay off the remaining balance. 2. MLTA. Payout can be used at the beneficiary's discretion for any financial need. 4. Financial security. 1. MRTA. Primarily focuses on mortgage protection. 2. MLTA. Provides additional financial security beyond just the mortgage. Chapter 4. Which option is right for you? Deciding between MRTA and MLTA ultimately depends on your personal financial situation and long-term goals. Here are some factors to consider when making your decision. 1. Current financial obligations. Evaluate your overall financial situation. If your primary concern is protecting your mortgage, MRTA may be sufficient. However, if you have additional debts or financial responsibilities, MLTA could provide more comprehensive coverage. 2. Budget for premiums. Consider your budget for insurance premiums. If you're looking for a more affordable option, MRTA might be the way to go. But if you can afford the higher premiums, MLTA offers broader coverage. 3. Future plans. Think about your long-term goals. If you plan to stay in your home for the foreseeable future and want to ensure your loved ones have financial flexibility, MLTA could be the better option. 4. Family financial security. Consider how your family would manage financially in your absence. MLTA's additional payout may offer greater peace of mind, while MRTA ensures the mortgage is paid off. Chapter 5. The application process for MRTA and MLTA. 1. Application steps for MRTA. 1. Step 1. Research and compare MRTA policies from different insurers. 2. Step 2. Gather necessary documents, such as proof of income and mortgage details. 3. Step 3. Fill out the application form and provide required information. 4. Step 4. Undergo a medical examination if required by the insurer. 5. Step 5. Review the policy terms and conditions before signing. 2. Application steps for MLTA. 1. Step 1. Research and compare MLTA policies from various providers. 2. Step 2. Prepare necessary documentation, including income proof and existing financial obligations. 3. Step 3. Complete the application and provide accurate information. 4. Step 4. Complete a medical examination if the insurer requests it. 5. Step 5. Review the policy thoroughly before finalizing your purchase. Chapter 6. Pros and cons of MRTA. Pros. 1. Affordability. Lower premiums make it accessible for many homeowners. 2. Mortgage protection. Ensures the mortgage balance is paid off in the event of death. 3. Joint coverage. Can be taken as a joint policy for couples. Cons. 1. Limited coverage. Only covers the mortgage, not additional financial needs. 2. Decreasing benefit. The payout reduces over time, which may not provide adequate support for loved ones. Chapter 7. Pros and cons of MLTA. Pros. 1. Level coverage. Fixed payout amount offers consistent financial support. 2. Financial flexibility. Beneficiaries can use the payout for various expenses. 3. Comprehensive protection. Provides additional security beyond mortgage obligations. Cons. 1. Higher premiums, more expensive than MRTA, which may not fit every budget. 2. Complexity, may require more consideration to fully understand its benefits. Chapter 8. Real-life scenarios. To help illustrate the differences between MRTA and MLTA, let's look at a couple of real-life scenarios. Scenario 1. The young family John and Sarah, a young couple, recently purchased their first home with a 30-year mortgage. They are both in their early 30s and have young children. They decide to go with MRTA because 1. They find the premiums affordable and fit within their budget. 2. They prioritize protecting their mortgage to ensure their children keep their home if something happens to either parent. In this case, MRTA provides the necessary protection for their mortgage while keeping their monthly expenses manageable. Scenario 2. The established family Lisa, a single mother of 2 teenagers, has a substantial mortgage and other financial responsibilities. She chooses MLTA because 1. She wants her children to have financial security beyond just the mortgage. 2. The level coverage ensures that they receive a lump sum to cover living expenses and any additional debts if something happens to her. In this scenario, MLTA offers Lisa peace of mind knowing that her children will have extra financial support if needed. Chapter 9. Common questions about MRTA and MLTA. 1. Can I switch from MRTA to MLTA? Yes, you can switch policies, but it may involve cancelling your current MRTA and applying for MLTA. Ensure you understand any implications or penalties before making the switch. 2. How do I determine how much coverage I need? Evaluate your mortgage balance, other debts, and ongoing expenses. Consider future financial needs for your family to determine the appropriate coverage amount. 3. Can I get MRTA or MLTA if I have pre-existing health conditions? It may be possible, but it depends on the insurer's policies. Some may require medical underwriting, which could affect your premium or eligibility. 4. What happens if I outlive my policy term? If you outlive the term for either MRTA or MLTA, the coverage will end, and you won't receive any payout. You can consider renewing or purchasing a new policy if needed. 5. Can I have both MRTA and MLTA? Yes, it's possible to have both types of coverage for additional protection. However, you should assess whether this makes sense for your financial situation. Chapter 10, Final Thoughts in conclusion. Understanding the differences between MRTA and MLTA is crucial for homeowners looking to protect their mortgage and provide financial security for their loved ones. Choosing the right option depends on various factors, including your financial situation, long-term goals, and the specific needs of your family. When considering MRTA, you benefit from its affordability and focused mortgage protection, making it a suitable choice for many first-time homebuyers or those on a tighter budget. On the other hand, MLTA offers comprehensive financial security through its level coverage, ensuring your family has more flexibility in managing their finances if something were to happen to you. As you move forward in your decision-making process, keep the following tips in mind. 1. Assess your needs. Take the time to evaluate your current financial obligations, future goals, and the level of security you want to provide for your family. 2. Shop around. Don't settle for the first policy you come across. 2. Research multiple providers and compare policies to find the best fit for your needs and budget. 3. Consult professionals. Consider speaking with a financial advisor or insurance agent who can help guide you through the options and ensure you make an informed decision. 4. Review regularly. Life circumstances change, so it's essential to review your insurance needs periodically. 4. As your mortgage balance decreases or your financial situation evolves, you may find it beneficial to adjust your coverage. By understanding MRTA and MLTA, you can better prepare yourself and your family for the future. The right mortgage protection can provide peace of mind and ensure that your loved ones are not left with financial burdens during challenging times. Thank you for joining us today on Muscular Brain, Fat Wallet. If you found this video helpful, please like, subscribe, and share it with others who might benefit from this information. Let us know in the comments what topics you'd like us to cover next.